Haya, tuendelee wenye tuko. Those who are not around watajipanga. We cannot wait for people. Sisi tutaendelea. Hata kama tunafunza mtu mmoja, wenye ameingia ndio tunafunza. So let us move on. So let us move on with our what we are doing. Did you attempt the question that I shared? Did you guys attempt the question? Did you attempt the question? Yes. Did you guys attempt the question?
Mwalimu, me, I did not attempt the question.
Okay, we can do it in the class. So we are still under valuation. So we are still under valuation concepts. So we can go to our past paper and check those questions. So let us open the sitting for. We can start with which sitting? Tunafanya mbili ama tatu. Then let us see ilikuwa sitting gani hiyo. Tunafanya mbili ama tatu and then ilikuwa hii sitting kuna swali tumepeana huku juu. This is latest. There was a question.
April 2023, question 3B.
April 2023. Okay, let me go to that question. April 2023. April 2023. Question number 3B. Yes, so UMI Limited is contemplating to issue. So that one is April 2023, question 3B. April 2023, question number 3, boy. So wanasema Ulinzi Limited is contemplating to issue 8% debenture redeemable at shillings 100 for 3 years time. So we can compute annuity. In that case, annuity is equal to the percentage of the par value. And in this case, it is 80% of 100, which is Kenya shillings. 8. That is per bond or per, is it bond? So that is per bond. So per bond, so that's the annuity. Then we continue. Alternatively, each bond can be converted on the date into 30 ordinary shares of a company. The current market price is 3.3. Now we need to calculate the maturity value. Maturity value, which is the market price, 1 plus G raised to N. N is the maturity period. Now in this case, our market price is 3.3. 3.3. We add our growth rate, which is on the way to grow at the rate of 5%, which is 0.05. For how many years? The years is for 3 years. Just for 3 years. Just for 3 years. So N is 3. So raised to 3. So itakuwa ngapi? Itakuwa 3.3 into bracket 1 plus 0.05 raised to 3, which itakuwa ni 3.820. Yeah. Now we know 1 bond goes for how many shares in this case? For 30 shares. But our bond is 3.820. So because multiply, you find that 3.820 times 30, which is our book value. You can call it the book value if you want. Or you can go with the maturity value. You can go with the maturity value of the book value. So times 30, which is 114.60. So 3.820 times 20 times 2 times 30. 114.60. That one is correct. Now we know that to find the intrinsic value is equal to the annuity multiply with the present value interest factor for annuity plus we take the maturity value, which is our book value, we multiply with the present value interest factor for n period. Remember our rate is 6%. Remember our rate is 6%. So remember our rate is 6%. Now we need to do it here so we can say that our annuity is 8 shillings. So 6% tuende kwa year 3. So unaenda kwa table year 6 then uende kwa hiyo table nitaipata every time. Nani kwa hiyo table? Let me find the table. So nimeipata the table. So tunaenda kwa annuity. So annuity unatumia table ya chini, the one for the present value for annuity. Unaangalia hapo juu the present value for annuity. Tunaenda kwa 6% kwa year 3. Unapata ngapi? Tukienda let me share the board, the screen so that you see the item. So ndio hiyo nimeshare. So unaenda kwa 6%. So ndio hiyo hapo, you go to 6% ndio hiyo. Then unaenda kwa year 3. Year 3 ni hiyo hapo juu yake hiyo 2 point. So unaenda kwa table imeandikwa, look at this table, unaenda kwa hiyo table. For annuity unaenda imeandikwa annuity. Present value for annuity unaangalia hiyo table imeandikwa hivyo. Present value for annuity. So ni 2.6760. Unakuja unaandika hapo 2.6730. Then the book value unajua ni 114.6. So hiyo inaenda kwa table ya juu imeandikwa n period. So ya next one, the other one nataka ndio nikitoka hapa tuko tumeangalia zote. This one unaenda kwa hiyo table imeandikwa pale juu the present value for n period ndio hiyo. So unaenda the one is those one goes with the market value. Unaenda kwa 6% ndio 6%, then unaenda kwa year 3 which is ndio hapo. You can see 0.8396. 0.8396. So ukishafanya hivyo, let me now share the board. So let me now share the board. So ndio hiyo. So 8 times the annuity ni 2.6730 plus 114.6 times 0.8396. So what will be your intrinsic value? So intrinsic value itakuwa 8 times 2.673 plus 114.6 times 0.8396. So the answer is Kenya shillings 117.60. So that is the intrinsic value. 117.60. 117.60. 117.60. Any question concerning that one? That question? Any question? I think there's no any question concerning that one. I think you have to exhaust. I think that one we have exhausted. Well, you can go to something else. We can go to something else. September 2021, let me see if we can do for the September 2021. Before we figure out September 2021, let's see if we have another question before September 2021. So hapo ni money of page 43, that table, you might need it. Let us look for another question. So tulikuwa tumefika that question alikuwa anatuambia nini? So hatujamaliza hiyo swali. So compute the following. Number 1, the market value of the bond assuming conversion after 3 years. So hii ndio tumefanya. So that is number A. Assuming conversion after 3 years. Number 2, compute the following. The floor value of the bond assuming the redemption occurred at par. Assume the redemption occurred at par. Now, wakisema at par means at the par value. So this will be the answer. In this case, the intrinsic value will be equal to 8 times. So at par, itakuwa 2.673 plus. Now at par, kumaanisha this value will be redeemed at par value. Which is our par value? Our par value ndio hii 100. So to be redeemed at 100 shillings. So assuming to be redeemed at 8 shillings, 0.8396. So utapata the value of the bond if it were to redeem at par. Number C, assuming that it will be redeemed. Compute the conversion premium. Compute the conversion premium. Now, the conversion premium in this case, conversion premium. Now, find for me this figure. Calculate for me that figure. Calculate for me that figure. Muni calculate that figure tafadhali haraka haraka. Calculate for me that figure. Now, conversion premium will equal to market value of the bond. Market value of bond with less current conversion value. Current conversion value with less the current conversion value. So we can say the 11 point
105.344.
Let's compute the current conversion value. Current conversion value. So current conversion value is the number of shares. Times MPS. So number of shares ni ngapi? Ilikuwa ni 30 times 3.3. Inakuja ngapi? 30 times 3.3. Ngapi?
99.
Ngapi? So 30 times
99.
99. So Kenya shillings 99. So that's the value. And then this one, the market value of the bond, ndio hii. The market value of the bond is 117.6. So tunasema the conversion premium itakuwa ni 117.6 minus 99. 117.6 minus 99. So the answer is, so the premium so to compute the conversion premium is 18.6. That is the premium or the profit. That is the premium or the profit. So that is part A, B, and C. So part B, what you change is that it goes at par and not as per conversion. Remember this one, this item, this one is at per conversion. So we convert 30 times 33, then we incorporate the rate. That is the conversion. Uko sawa? So 114.6. But in this case, we need to calculate the conversion value, the current conversion value, which is 30 and 3.3, which is 99. Then we less, you get the figure. That one is quite. I think that one is okay. That one is very, very fine. So we can look for another question, the last one. We can look for the last question so that we cement what we have tumetoka kufanya. So we can try and cement. Okay, let's see if we can find another one. Aha. Hizi maswali za kwanza zimejificha. Kuna mwenye ameona moja? Kuna mwenye ameona moja? I think kama hakuna. Kama hakuna. Kulingana vile nimezunguka. December 2021, do you have a question? December 2021. December 2021. Yes, September 2021. September 2021, question number 1B. September 2021, question number 1B. September 2021, question number 1B. Open September 2021, question number 1B. Someone to read for us. September 2021, question number 1B. So September. So now make sure you screenshot so that finish September 2021. September 2021, question number 1B. Someone to read for us. That is on page 47. That is on page 47. Okay, let me read the question. September. Hakuna mimi anasomea nikivuta board. Sasa rub the board. Tunasema September 2021.
Which page?
47. Number 1B. Page 47. The question is about Belta Limited. Hakuna haya amepata.
Beta Limited issued a 16% corporate bond with a par value of 1,000 shillings. The bond will either be redeemed at 20% premium after 5 years or convertible into equity at a conversion rate of 100 shillings per 2 ordinary shares. Each ordinary share is currently trading at the security exchange for 50 shillings. It is expected that the share price will increase at a constant rate of 5% each year. The minimum required rate of return by investors is 12% required. The current value of redeemable bond, the current value of the convertible bond, proposed for advantage that would occur to Beta Limited by using commercial papers as a source of finance?
So how do you do that question? Hiyo swali tutaifanyaje jameni, watu wangu? Unaonaje? So we need to find what we call the annuities. So that's the first thing. So we need to find the annuities. Just a moment, kuna kitu kidogo tu. Sawa sawa. I think we can move on now. So September 2021 is our question. So we are supposed to calculate the intrinsic value. So when you calculate when calculating the intrinsic value, we need to consider two items. We need to consider the bond value. So the bond value. So tutasema hivi. Where is that question? So so annuity. So we start with the annuity. Annuity, which is 16% of our par value. What's our par value? Which is 1,000. So times 1,000, which is Kenya shillings, I think 160. Now it will be there for many years. So the bond will be either be redeemed at 20% premium for 5 years. So we have alternatives, so options. We have options to consider. The first option, it can be redeemed at 120 premium. So itakuwa ni 120%. Kwa sababu 20 profit. So 100 plus 20, so that we get the profit for 5 years. Or it can be converted into equity. Or number two, they can say to convert. Convertible. Now, if they decide to convert, so they will say to convert at a rate of, so for every 100 bond, I think that one is correct. No, 2 shares. Is that one correct? According to that question. For everyone, sorry, for every, we can say for every Kenya shillings 100, for every Kenya shillings 100 for bond, because we were talking about bond, it's either for 2 shares. I think that one is correct. It's either for the 2 shares. Each ordinary shares are carried trading at the market price. The market price at this rate is 50 shillings. 50 shillings. And then growth rate, G is 5%. G is 5%. And then our R is 12%. So let's start with the first one, number A. We are supposed to find the intrinsic value using the current market value of the redeemable bond. So intrinsic value, itakuwa the annuity multiplied by the present value interest factor for annuity. Then now wametuambia itaenda na the maturity value, so the redeemable value. So we are supposed to take the redeemable value value times the present value interest factor for n period. Now we know our annuity. Now before we input the formula, let's calculate the redeemable value. Now redeemable value, you can need to calculate the redeemable value. Redeemable value is the 120%. Now the 120% of the par value. Our par value is 1,000. So 120% of 1,000 in ngapi? 120% of 1,000. How much is that? That is 1,200. Is that correct? That one is correct figure. So we can say that our intrinsic value will be equal to the annuity. Our annuity, which is 160, we multiply with the present value. So 12%, we need to find this value. Present value interest factor for annuity, we need to find it in the table. Plus, now the table value here, 1,200, times the present value interest factor for n period. Then I find the figures, 160 times. We need to find those figures from our kama iko hapo juu yake. Let me see. Shida hizi nini zinatoroka, zinajificha hizo table. Sawa, nimepata. Let me share the screen. Let me share the screen so that you can see the table. Let me share. Ndio hiyo. So tumesema ni 12%. So let's start with the one for annuity. Let's go start with the one for annuity. Ndio hiyo chini hapo, chini yake. Tunamuka hapo. Ndio hiyo. So the present value for annuity ndio hiyo. Tunaenda kwa 12%. Now it is for how many years? This board was for how many years? Waituambia ni for how many years? Wa mwadhani nimetoka hapo. You go for how many years? From your side?
5.
So 5 years. So unakuja hapa kwa 5. 5 ndio hapa chini. 3.6024. So wacha niandike 3.6048. 3.6048. Then ya huyo mwingine for n period. So unakuja hii nyingine ndio hapa chini for n period, ndio unaangalia hapo juu. Umeandikia hapo n period, you can see it there, end of n. Unakuja kwa 12% afu unaenda kwa 5. 0.5674. 0.5674. I think tukishafanya hivyo, I can stop sharing. So ndio hiyo the table, you can see it clearly now. You can see it clearly now. So what will be the answer? Give me the answer. Give me the answer. Give me the answer for that one. Give me the answer for that one. Itakuwa ni 160 times 3.6048 plus 1200 times 0.56 74. And that one we can confidently say that this amount is 1,257.648 Kenya shillings per bond. Kenya shillings per bond. That one is okay. Number 2, we are to check about the convertible value. So let us calculate the convertible value. Convertible value. How do you get it? We know the first one, the maturity value is equals to MPS 1 plus G raised to N. And in this case, our market price is 50 shillings. You can say it is 50. 1 plus G. Our G tunajua ni 5%, which is 0.05. Amesema the years is 5 years. We shall get first the maturity value. So 50 into bracket 1 plus 0.05 raised to 5, which is 63.814. Now, then the number of shares for every 100. Now we need to find the number of shares. So anasema for every 100 shillings, for every Kenya shillings, 100 per bond is 2 shares. Utajiuliza, how about Kenya shillings 1,000 per bond? Because that is our power value. So utajiuliza this one. What about our 1,000 shillings per bond? Itakuwa na how many shares? So that is the question you need to ask yourself. So how many shares tutakuwa nayo? So that we know the number of shares. How many number of shares? How many number of shares? Yes. How many number of
20.
shares?
20.
Yes, 20. So itakuwa hivi. So this is the answer. Ni 1000 times 2. So 1000 times 2 divided by 100, which is 20 shares. Now we can now find our convertible value. Convertible value, or you can just call it the book value if you want. It is the 20 shares. Multiply with our 63.814. So times 20, which is I think 1276.28. Now we can find the intrinsic value. Intrinsic value. Itakuwa our annuity, which is the same here. 160 times 3.6048 plus. Now in this case, we change this figure from the redeemable value. Now we use the convertible value, which is 1276.28. The rate for conversion is the same, 0.5674. So that one is how you get that answer. So 160 times 3.6048 plus 1276.28 times 0.5674. Now your answer is Kenya shillings 1,329 per bond. That is how you are supposed to answer that question. That is how you are supposed to answer that question. Any question concerning that one? Any question concerning that question? So that's all about that question. That question is over. Assignment. Now make sure you do this assignment kwa sababu usipofanya itakuramba kabisa. May 2019, not May 2019, itakuwa nimewatanganya. May 2016. May 2016. May 2016, the question is question number 2C. We're also having another question here. I don't know if it is the same. I don't know kama it's the same, but let me just give you utaangalia kama ni the same. November 2015, number 1C. You can just open and see how it they zinakaa before we can open them and see when zinakaa, or we just try them. Or you just try them. Tutasema May 2016. May 2016. So May 2016. May. Hiyo sorry comparison. Sorry kama taipata. You just go and check it. Go and check it. Yes, yeah, I think you can go and try that question. Sasa let us move on. Let us just move on. Maana kufika kwa chini ni mbali. Let us introduce something else. So you also have May 2015 2C. You also have May 2015 question number 2C. May 2015 question number 2C. That is okay. May 2012, if you have that first paper ya kitambo, question number 2B. If you have that first paper, and pia kama uko na the other one for June 2005, Question number 1B. Hizi hizo za kitambo kabisa. So kindly make sure you try those questions. So these are your assignment now. Let's go to the next theory. The technical theory. 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 So I hope you are okay with the fundamental theory. So I hope you are okay with the fundamental theory. Haina mambo mingi. So we can go to technical theory. Technical. We call them the technical theory. Technical theory, we can say number one, first point, you can say it is also called the chartist theory. It is also called chartist theory. So it's also called the chartist theory. You can call it the chartist theory. Then you can say and then we can say this theory states that, so this theory states that the price pattern of the past, the price pattern of the past could repeat itself. Could repeat itself. So the theory states that the price pattern of the past. So the theory states that the price pattern of the past could repeat itself. Could repeat itself. So when you are trying to predict the market prices of anything, the theory says that it is good to consider the previous price pattern. So what happened yesterday or the day after the other day could be repeated in the future. Could be repeated in the future. So the price pattern of the past could repeat itself. Could repeat itself. Then you can see it uses graphs or charts. It uses graphs or charts. It uses graph or charts as its main control tool. So it uses graphs or charts as the main control tools. For example, they can use the candlesticks, they can use the line graph, the bar graph to determine the market. So it depends with the market. So they can use either of those items. Now, in this case, past price patterns are observed. In this case, the past price pattern are observed and recorded with expectation that that they will be repeat itself, that they would repeat in the future. So the past price pattern are recorded and observed. so are observed and recorded with the expression that pattern will also be repeated in the future. So three price pattern. The price pattern are identified in this theory. So this theory identifies three patterns. So you have number one, the primary pattern or trend. Primary pattern, or you can call them the primary trend. The primary pattern or trend. This is the price pattern which has been observed and plotted for a period of more than 1 year. We say these are price pattern. These are price pattern which has been observed, and plotted. These are the price pattern which have been observed and plotted for a period of more than 1 year. For a period of more than 1 year. For a period of more than a year. That is number one. Number two, you have the secondary pattern. Secondary pattern. What is this secondary pattern? Now, secondary pattern, this is the price pattern which has been observed and plotted for a period of less than a year. For a period of less than a year. So this are price pattern which has been observed and plotted for a period of less than a year. Number C, we can think about the tertiary pattern or trend. Tertiary pattern or trend, and we say these are price pattern which has been observed and recorded for a short period of time, e.g. on a weekly basis or daily basis. These are price patterns which have been observed, and plotted for a short period of time. I.e. Daily or weekly or monthly. That one is okay. So that is what we can talk about it. This theory, leads to the random walk theory. This theory leads to the random walk theory. So let us talk about the random walk theory. Random walk theory. So this is the third theory. These are fundamental theory. Number 2 is technical theory. So number 3. So let us talk about the random walk theory. Random walk theory. So random walk theory. So what is one random walk theory? Now, this theory says that it is not possible to produce the theoretical value of a security. No, we will not use this definition. Let me use another one. There's another definition here. Let me give you. I don't know if I pattern in time. The theories. So the random walk theory. Now, this theory states, so we say, let me use this one. This theory states that the price will be on a random manner. That price of securities, the price of a security will be on a random manner. So this theory states that the price of a security will be on a random manner depending on the information released in the market. Depending on the information released in the market. On the information released in the market. So this theory states that the price of a security will be on a random manner depending on the information released in the market. Now, if the information about the security in the market is positive, then the price of the security might be stable. But if the information about the security is not good in the market, then it might affect poorly on the price of that security. So the price of that security will depend on the information in the market. Now, this theory leads to efficient market hypothesis. Efficient market hypothesis. This theory is the efficient market hypothesis. So this theory is the efficient market hypothesis. So that theory will raise what we call the efficient market hypothesis. So let's talk about the efficient market hypothesis. Let us talk about the efficient market hypothesis. Efficient market hypothesis. So allow me to wrap the upper part. So allow me to wrap this board. So allow me to wrap the board so that we can talk about the efficient market hypothesis. Efficient market hypothesis. The efficient market hypothesis. Efficient market hypothesis. The efficient market hypothesis. So efficient market hypothesis, we can define it and say that information, whether good or bad, states that information, whether good or bad, so the information, whether good or bad, once revealed in the market, to the market, it quickly reflects to the price of the security. The price of the security. That's how this market states. So, so the information, whether good or bad, once revealed in the market, will automatically affect, or it will quickly reflect the price of the security. The price of the security. So that's some of the characteristics. So security of markets is said to be efficient if it has the following characteristics or features. The following characteristics or features. Number one, so the market is said to be efficient if it has the following characteristics. Number one, information once revealed in the market. Information once revealed in the market. Information once revealed in the market immediately affect the stock price. Immediately affects the market price, the security of the security. That's number one. So once the information is released in the market, it will immediately affect the price of that security. Number two, there is continuous trading in the market. Number two, there is continuous trading in the market. So that's another characteristics. There's a continuous trading in the market. So trading is not stopping. So trading is not stopping. So it is continuous. And then it also no speculation in the market. So it also has another characteristic that there is no speculation in the market. So there is no speculation. So everyone, meaning everyone has equal information, i.e., every participant has equal information. So no one is benefiting than the other. So no one has more information than any other trader or investor. So you all have equal information. So there is no speculation in that case. And then another characteristic is that no investor should receive. So no investor should receive information. So no investor should receive information earlier than other investors. Earlier than other investors. So no investor should receive more information than other investor. And then transaction cost and commissions paid to brokers should be minimal. So the cost should be minimal. The cost should be minimal. And then ya mwisho, experts should not gain abnormal profits. So there is no abnormal profits, not allowed. So any experts should not have abnormal profits. Levels stroke degrees of the, so let's talk about the level of the forms. Level stroke form stroke degree of EMH. Efficient market hypothesis. So the efficient market hypothesis. So what are these levels of this item? Number one, we have weak form. Now, this is where the security prices or the security price reflects only the historical pattern. So that is all. That is about it. So we talk about weak form. This is where the security price reflects only the historical pattern. So it will reflect only the historical pattern. So this is where the security price will reflect all the historical information concerning the performance of that pattern. Number two, so we don't need to write so much thing. Semi-strong form. This is where the security price will reflect both past and the present information concerning the security. So this is where the security price will reflect both historical and present. Patterns of the security. Of the market. So this one reflects both the current and the historical. And then number three, we can talk about the strong form. Now, in this case, the security price will reflect both historical, present, and the future patterns in the market. So this is where the security price will reflect historical, present, and future information or patterns, and future informations or patterns about the markets. That is all when we are talking about the EMH. So the EMH, that's what we need to know. When we talk about the EMH, that is what you need to know. That is what you need to know. That is what you need to know. Now we shall talk about market anomalies later. Let's talk about valuation of ordinary shares. 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 So that's where we shall concentrate. Also, tujaribu kufanya haraka haraka tumalize hata valuation of ordinary shares so that the rest of the item to tumalizie the next class tukutana, so that we tumalizie na valuation once and for all. So valuation of ordinary shares. Valuation of ordinary shares. Ni kama imekataa kuonekana. Sasa tunasema valuation of ordinary shares. Valuation of ordinary shares. So valuation of ordinary shares. So we can write and say, so ordinary shares are classified into three. Ordinary shares are classified into three. Ordinary shares are classified into three. For purpose of valuation. For the purpose of valuation. So ordinary shares will be classified into three for the purpose of valuation. Number one, we have the zero dividend. Zero dividend growth rate. Ordinary share. That's number one. Zero dividend ordinary share. Zero dividend growth rate. Zero dividend growth rate ordinary share. We have the constant dividend growth rate. Constant dividend growth rate. Dividend growth rate. Ordinary share. Ordinary share. So constant dividend growth rate, ordinary share. the constant dividend growth, and then you have non-constant dividend growth rate, non-constant dividend growth rate, ordinary share. Ordinary shares. We start with the first one, number A. We start with the first one. We start with the zero rate, zero dividend growth rate. We start with the zero dividend growth rate, ordinary shares. You can start with the first one. That one as the first one. So you can start with that one as the first one. So we say in this case, the company promises so in this case the company promises constant dividend per share, constant dividend per share. So in this case the company promises constant dividend per share for each period, i.e. DO equals to D1 for period 1, is equals to dividend for period 2, is equals to dividend for period 3, up to period n. So the dividend for period 0 is equal to the dividend for period 1, equal to dividend for period 2, dividend for period 3, up to the dividend for period n. So the dividend is the same. And then we say, in this case, ordinary shareholders are treated as if they are preference shareholders, as if they are preference shareholders. So when in the case where our dividend is common, then the shareholder will be treated as if they are preference shareholders. Now you can say the constant dividend per share, will represent annuity. So you underline the word annuity, represent annuity. Now, therefore, so you can say therefore, intrinsic value will be given as follows. Now, so our intrinsic value, which is our PO. PO means intrinsic value. Remember, in terms of PO, the match intrinsic value will be equal to annuity over R, or you can say dividend over R. So remember, this one is in perpetuity, of which you can also say it is equal to dividends or annuity divided by the cost of capital. I think we can do a question now concerning that one. We can look for a question. I think we can look for a question concerning that one. We can go to this setting. November 2016. Go to November 2016 first. November 2016. November 2016. Let me see if ni hiyo swali. November 2016. November 2016. You can't apata. The papers got disorganized. November 2016. I think the question is question number 4B. November 2016, question number 4B. November 2016, question number 4B. Nada tusomea. November 2016, 4B. It's on page 93. Go to page 93. Go to page 93. Go to page 93.
A firm issued 10% preference shares to raise funds. The shares have a par value of shillings 100 each and are currently selling at shillings 110 each. The minimum required rate of return by the investors is 8% required. Explain whether the share is overvalued or undervalued by the market.
Okay, thank you. Now, so according to that question, you can find the annuity or the dividend. Now, annuity or the dividend in this case is equal to the percentage of the par value. And if you go to our question, you can see that the percentage is 10%. Is 10%. And our par value is Kenya shillings 100, meaning it is Kenya shillings 10 per share. That is number one. Number two, we need to find our R. Our R from the question it is 8%, which is 0.08. So we can find our PO. And now our PO is equals to 10. So our PO itakuwa ni annuity over R, 10 over 0.08. So give me the figure. 10 divided by 0.08. 10 divided by 0.08. It is Kenya shillings 125 per share. Now remember our market price. From the question, our market price is how much? From the question, our market price is Kenya shillings 110 per share. Now, when you compare these two prices, 125 and 110, is it overvalued or undervalued? According to what we did in our first class, page 1. The information we give in page 1, we say that when the intrinsic value is greater than the market value, when the intrinsic value is greater than the market value, is it overvalued or undervalued? From our first class. So if the
Overvalued.
So if the market price is less than the intrinsic value, then the value is said to be, yes, undervalued, Silvio. So advice. The PO, we say the security is undervalued since MPS is less than PO. So MPS means the market price, PO means intrinsic value. I think that one is okay. That one is okay. We can move on to another thing. We can go to the next number 1. Number 2, constant dividend growth rate. constant dividend growth rate, constant dividend growth rate, constant dividend growth rate. So allow me to wrap. So kama hujaandika andika tafadhali haraka haraka. Constant dividend growth rate. So we have to go to the number 2, the constant dividend growth. Nafuta zote so that nianzie hapa juu. Constant and then tumalizie na constant. Then that will be the end of our class today. Mpaka Monday. So let's go to constant dividend growth rate. So constant dividend growth rate. Constant dividend growth rate. Constant dividend growth rate. So constant dividend growth rate. Constant dividend growth rate. Ordinary share. So constant dividend growth rate. Constant dividend growth rate. We say this is where the dividend will increase at a constant growth rate. We say this is where the dividend will increase. This is where the dividend will increase. This is where the dividend will increase at a constant growth rate. At a constant growth rate. This is where the dividend will increase. This is where the dividend will increase at a constant growth rate until infinity. Until infinity. Until infinity. In this case, DPS or dividend per share, DPS, the dividend per share, or the DPS will be computed as follows. Will be computed as follows. D1, the quantity DO 1 plus G raised to N raised to 1. Then D2, the quantity DO 1 plus G raised to 2. But I don't prefer this method anyway. Let me just write it down. But I don't prefer this one. I will show you another one. So it tunaandika tu. Then intrinsic value. I will say intrinsic value will be computed using the Godon's model. Now this is the Godon's model. Intrinsic value is equal to DO 1 plus G raised to R minus G. So G is the growth rate. growth rate, DO, DPS, dividend per share, R, the cost of capital, cost of capital. We don't need to complicate item. Assumptions. Let us see the assumption first before we do a question. Assumptions. Assumptions. Assumption of this model. Assumptions. Now the assumptions they are well explained. Number one, the firm must be an equity finance. Number one, the firm must be an equity finance. Firm. What does it mean? It means that there is no debt, i.e., no debt finance. So the Godot's model cannot be applied in the case where the firm is using debt finance. And then internal rate of return is constant. Internal rate of return is constant. So the rate of return is assumed to be constant. Growth rate is also constant. And you can say cost of capital is constant. Cost of capital is constant. Cost of capital is constant. No corporation tax. No corporation taxes. No corporation taxes. Retention ratio is constant. Retention ratio is constant. Yeah. Growth rate is constant. Is constant. Payout ratio is constant. Payout ratio is constant. What else? Ya mwisho. No transaction cost. We should assume that there is no transaction cost. It assumes no transaction cost. No transaction cost. NB. So NB. Assumptions are the limitation. Assumptions are the limitation. So can you give the limitation of the model? You can twist the assumption. You just twist the assumption. For example, unaweza sema that the firm must be an equity finance. So it is very rare to find a company using equity finance only. So unasema it is not possible for a firm to rely on equity finance only. Number two, the rate of return is constant. Now, the rate of return, because of inflation, because of the changes in the market, the internal rate of return cannot be constant. That one we know is a limitation. Cost of capital is constant. Now, because also of inflation and market conditions, the cost of capital cannot be the same from time to time. And therefore, when watakwambia you state the limitation, you just twist the assumption. You just twist the assumption. Now you can do a question. Now, before you do a question, let us see how we compute growth rate. Growth rate. Now G is computed as the retention ratio times return on equity. On equity. So growth rate is equal to retention ratio, return on equity. So RR. So G is growth rate. Growth rate. RR. The retention ratio. Retention ratio. So we have another formula which you can use also. For G, hata nifanyie hapa. Another formula to find G. G, I think itatoshea. So what is another formula we can use to find G? Let me see if I can find it. Now G is equals to N dN over dO minus 1. But remember, NB, N is equals to is N minus, okay. For example. So G is equals to N, and then N in number, so dN na dO. This one is the earliest DPS per share. Then this one is the latest. Sorry, this was supposed to be latest. It's supposed to be the opposite. Latest dividend per share. The other one is the earliest dividend per share. So the first one is the latest dividend per share. The other one is the latest dividend per share. Okay. So this method is called compounding method. So this method is called compounding method. And then this method is called the retention method. This method is called retention method. So one method is called retention method. The other one is called the compounding method. We can go to our past paper now. Let us go to our past paper and look for a question. I think tunafanya leo up to this method. Then on Monday, kuja tuendelee with another method. The part C, non-constant. Let us see if in our past paper, if we can get one. Let's go to our past paper and see if we can get one question or two questions. We can do two. Yes, last sitting. Hii hatuwezi fanya. Hiyo ni maana hatuwezi fanya. That one is non-constant. Hiyo hatuwezi fanya totally. Hiyo hatuwezi fanya. So let me just ignore it for now. But tukifanya hiyo ni last sitting. Hiyo tutafanya tukifanya non-constant growth rate. August 2024 kuna swali kweli. August 2024, do you have a question? August 2024. August 2024. August 2024, hakuna. April 2024, do you have a question? April 2024. April 2024. Kama we don't have a question there. Hapo hakuna. Tuende kwa December 2023, do you have a question? December 2023. Ni kitabu kisaitiwa. December 2023. Hakuna. December 2023 hakuna. August 2023. August 2023 kama pia hakuna. August 2023. Ni sioni hapo. August 2023. Hapo hakuna. Tuteremke tu April 2023. April 2023, do you have a question? April 2023. April 2023. April 2023. Pia hapo wako set. Ngoja. Not hiyo. December 2022. December 2022. You have a question for Godons? Moja kwa Godons model. December 2022. Hakuna. August 2022. August 2022 ni kama pia hakuna. August 2022. August 2022. Ala. Hakuna pia. August 2022 bunge hakuna. Pale chini blah 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 blah. That one is the other non-constant. April 2022. April 2022. Kwani kitambo aje? April 2022. April 2022 ni kama pia hakuna. Ningejua ningeangalia before class. Yes, nimefika. December 2021. December 2021. December 2021 question number 1D. That's on page 39. Page 39. Page 39. So let's go to page 39, December 2021, question number 1D. December 2029, question number 1D. December 2029, question number 1D. Tunaanza tusomea swali. Linet tunaweza tusomea sahi. Linet.
Hello, siwezi soma, there's some noise kwa background.
Okay.
There's a baby hapa.
Haina shida. Don't worry.
Okay.
Yeah.
The following data was extracted from the financial records of Faraja Limited. Earning before interest and tax ni 400 million. Dividend payout ratio 40%. Number of outstanding ordinary shares 100 million. Equity capitalization rate at 15%. Return on investment at 12%. Corporate tax rate at 30% required. The value of Faraja Limited ordinary share using the Gordon's model.
Thank you. So that one is fine. So when we find the value of the interest value, so the PO, so I'll be using the word PO. If you can the word PO, just know that we are talking about the interest value or the theoretical. Some people use theoretical value, some people use the real value, some use the interest value. So the same item or the same thing. So PO means intrinsic value or the theoretical value. So it's equal to our dividend, which is DO 1 plus G over R minus G. So we need to find these items. Now, if we go to this question again, it is clear we are missing some item. Number one, we don't have the dividends. So one of the items we don't know is the dividend. That one we should agree. We don't have the dividends. So we need to compute the dividend. Number two, we don't have the growth rate, G. So we need to compute the growth rate. And number three, we don't have what? We don't have what? Need for two. So let us compute dividends. So computation of dividend per share. Computation of dividend per share. Or you can call it the DO if you want. The DO. Now, from the information you can see we have the earning before interest and tax. So we have earnings. Earnings before interest and tax. Earning before interest and tax is 400,000. Now, one of the assumptions we said is that in this model, Godon's model, we don't have the debt finance, meaning interest is zero. So when we say less interest, the interest is zero because on this model, we said, so earnings before tax. So tumetoa interest. So interest is 0. Reason why we say that this model assumes that we don't have debt finance. So the interest expense is 0. So the interest expense is 0. So 400,000. Then we are supposed to raise the tax. And we said, another assumption is we said that, what do we say? We said that there are no taxes. Is that correct? We said that there are no taxes. There are no corporate tax. Is that one correct? Okay, so that the corporate tax was 30%. Now, this model assumes that there are no taxes. So tax is 0. So meaning earnings after tax. So tunasema earnings before interest and tax, then earnings before tax, because tumetoa interest, so itabaki tukitoa interest unabaki earnings before tax. Let's say just earnings before tax, then earnings after tax. So tutoe tax sasa. So earnings after tax. Now this one tumesema tax hakuna. So kama tax hakuna, it means that the tax is 0. So kumaanisha when we're talking using the Godon's model, our earning after tax is itakuwa hiyo. Now we can get the earnings per share, earnings per share, earnings per shares. So earnings per share is equals to earnings after tax, earnings after tax divided with the number of shares, number of ordinary shares. So tuanze, so what will be the EPS? So earning per share itakuwa earning per share itakuwa ni earnings after tax, which is 400,000. So the 400 million divided with the number of shares. Number of shares ni ngapi? 100 million. So earning per share itakuwa ngapi? Itakuwa ni Kenya shillings 4 per share. So that we have, so hapo tumesha calculate earning per share as that figure. So that one tumepata earning per share as 4 shillings per share. Now, how do you get the dividend per share? Dividend per share inakuangaje? Formula. So this is the formula. Dividend payout ratio. This is the formula. We shall say dividend payout ratio. Payout ratio is equals to DPS over EPS. DPS over EPS. Dividend. So EPS, DPS ndio hii hapa. DPS inamaanisha dividend per share. Is our DO. Remember our DO ni dividend per share. This one means dividend per share. Remember DO. Remember DO is the dividend per share. Dividend per share. DPS per share. So it is our DPS. Now, what's our payout ratio in the question? Now, if you go to our question, we can see that the dividend payout ratio is 40%. So times 100%. So because our part here in percentage. So our dividend payout ratio is 40%. 40% is equals to our DPS. Ndio tunatafuta, we don't know our DO. Tutaandika hapa DPS over our EPS. So we have our EPS here as 4 shillings times 100. Now find the DPS. To find the DPS. So find the DPS. Find the DPS. To find the DPS itakuwa ngapi? To find the DPS. So DPS itakuwa ni ngapi? Itakuwa ni 40% times 4 over 100%. So dividend per share itakuwa ngapi? Itakuwa ni 40 times 4 over 100. 40 times 4 divided by 100, which is Kenya shillings. So DPS is Kenya shillings 1.6 per share. So hapo tumejaribu. Another item that we need to consider now is how to get the growth rate. How to get our growth rate, G. And in this case, I use the retention method. So remember, our growth rate is equal to the retention rate, retention ratio times return on equity. Return on equity. Now, in this case, if we check clearly, we don't have the return on equity now. If the return on equity is not there, if we say if return on equity is not given, use capitalization rate. Use capitalization rate. In our case, our capitalization rate ni ngapi? From the question. So kama ROE hakuna use the capitalization rate. So the capitalization rate is 15%. It is 15%. Now, retention ratio is equal to 1 minus payout ratio. Payout ratio. So retention ratio, RR, which is our retention ratio is equal to 1 minus payout ratio. And remember our payout ratio is 40%. 40%, meaning our retention ratio is 1 minus 0.4. Now, if we are paying, so since kama tunalipa 40%, remember our earnings ni 100%. If you tunalipa 40%, tunabaki na ngapi? Tunabaki na 60%. So if you are paying 60%, kumaanisha payout we are paying. So the dividend payout ratios, not ratio. These are supposed to be ratio. Now, if our ratio is 40%, if you are paying, kama tunalipa 40%, kumaanisha inabaki ni 60. So 1 minus 0.4, which is 0.6 or the 60%. 0.6 or the 60%. So we can get our growth rate now in that case. G, itakuwa retention ratio, which is 0.4 times our capital rate, which is 15%. Itakuwa ni 0.4 times 15, which is 6%. Which is 6%. Now tumeshapata kila kitu. Our R in this case itakuwa from the question. We were given R? Yes, tutatumia return on investment. So our R will be equal to the return on investment, which is 12%. Now let's try to calculate the PO, the intrinsic value. So our PO is our dividend. So our dividend is 1.6. You can see it here. Our dividend is 1.6. The DO 1.6. 1 plus G. Our G is 6% to 0.06 over our R is 12%, which is 0.12 minus our G, which is 0.06. So find the value or the market price using that figure. So 1.6 into bracket 1 plus 0.06. What you get, you divide by 0.12 minus 0.06. Are you getting Kenya shillings 28.27? Kenya shillings 28.27 per share. Are you getting that for item? Are you getting the same figure?
Yes.
So that's how you are supposed to calculate that figure. So that's how you are supposed to use the Godon's model. So let me find for you your assignment. Let me find for you an assignment. Let me find for you assignment. May 2021. Just do the Godon's model. So this question that we were doing, it was for December 2021. So this question tumekuwa tukifanya ilikuwa ya December 2021. The question was question number 1D. Ile ilikuwa tukifanya. Now assignment. We shall meet on Monday. But this is your assignment. May 2021, question 1C. May 2021, number 1C. So May 2021, question number 1C. I think that one marks the end of constant growth rate, dividend growth rate, constant dividend growth rate. So any question? Do you people have any question? So I think no one has any question. So I want to wish you a lovely weekend. And God willing, we shall meet on Monday to continue. So you people have a lovely night. And keep doing what we are doing so that in your exam, mambo itakuwa sawa. So that is all. Let us meet on Monday. God willing. So goodbye.